how to trade with rising inflation and diverging monetary policy. And what I mean by diverging monetary policy, you have central banks with a specific view of where they believe the markets are going to be going, or how certain metrics or certain indicators are likely to be forecasted. But at the same time, you have market participants who sometimes don't always agree with central bankers, and that's what we're going to be discussing. And there's some data that I will be showing you as we proceed. Okay, so let me just bring that back. Right, we can stay on this screen over here. We can stay on the screen over here. Let me just remove this. So the sort of the key areas, right? So let's start with central banks. Okay, central banks. Now, there are three key main macroeconomic indicators a central bank views, and that is your GDP, you have your inflation, and then you have your employment levels. Okay. Now, let's start with GDP. GDP is showing us the growth in that nation, in that country, taking place on a yearly basis. Okay, that's the growth, right? The amount of growth we've seen in the economy. The productivity levels need to be high in this region as well. Okay, then we've got inflation, and what inflation is, I'll come back to that a little bit later, but inflation is another key metric. And employment levels. Employment levels, naturally, every economy or every country would want to keep their employment levels in check. Okay, now these are the three key main indicators used by central banks to determine how they adjust their monetary policy, how they adjust certain parameters. And the parameters they have in control falls under two areas: interest rates as well as QE. QE, yeah. Okay. So generally, central bankers will adjust interest rate levels according to how they feel the economy is going. If the economy is speeding up and it's growing too fast and it's getting hotter than expected, they want to cool it down. They want to slow it down just so that it doesn't go into a bubble formation where you see a large correction occurring. That's the key there, right? Or if the economy is, falling behind, and we've got potential recession upcoming, how can we defend that? How can we sort of minimize the impact of a recession? Maybe by reducing interest rate levels, and that allows for more borrowing capabilities at those lower interest rate levels. Or QE, quantitative easing. That's a method brought in to help prop up the market by buying assets, and those assets generally fall under bonds, okay? But it's also printing money. It's printing money to buy more assets. That's the key there. So we see M2, money supply, increase over this as well. Okay, so those are the sort of key levers that a central bank will have when they are deciding based on these three key parameters. Now, do remember, with whether it's GDP, just make sure we're right there. So whether it's the GDP or inflation or employment levels, these three are extremely important. They are of high relevance. Now, there are other smaller macro data releases like retail sales, producer prices index. Those also matter as well for the larger picture. But right now, we're just entirely focused on the key metrics that a central banker views on an ongoing basis. Okay, so now if we start to see, with the current situation we're in, right, and this is post-COVID. Okay, this is post-COVID. What we're seeing is GDP levels had, they've been rising steadily, and all of a sudden we had a significant crash occurring, and then we're looking for that recovery to occur. That's with your GDP level. Okay. Employment levels were at their all-time lows, and all of a sudden we have with COVID, then we're going to lockdown, a lot of furloughs taking place and so on, and then you have a jump in unemployment levels. Okay, and we're looking for markets eventually to come back down, employment levels to come back down to sort of those prior levels. And at this current moment, what we're seeing is GDP is not back to where it was previously and employment levels are not going back to where they were pre-COVID. Okay, but inflation has, where inflation rate was pretty much steady, and all of a sudden you had a fall with COVID, has now recovered substantially. It's far surpassed pre-COVID regions, pre-COVID levels. And that's the fear that central bankers have, is that now that inflation is overshooting, shall we say, it's overshooting above the pre-COVID levels, it's surpassed GDP and it's surpassed the employment recovery. What do we do now, right? And the question of market participants and what they would like to see is potentially a reduction in the QE programming, right? The quantitative easing program that's taking place, okay, a reduction in there, and that's where we're hearing, the Fed talking about tapering their balance sheet. You'll often hear these terminologies being used, but that's what that means. They're going to be reducing the amount of QE taking place, as well as the potential of raising interest rates to cool off the inflation levels, But that's not what is occurring. What is occurring is that there is talk of potentially QE tapering to take place. And in addition to that, there is also talks of raising interest rates, not in 2021, not in 2022, but in 2023. Okay, so 2-year projection from now is what they've given us of raising interest rates. That's very far away. That's far away currently, right? So, that is what market participants are viewing at the moment. Now, why are central banks not in a rush to cool down the overshooting inflation levels? Why? Now, that is largely down to that they believe it's transitory, which means that due to certain reasons, and I'll touch on those reasons a little bit later, it's unlikely that inflation will continue to shoot up. At some point, it will calm back down due to sort of supply chain reasons, and then eventually come back to a certain parameter, certain region, okay? And that's what the hope is by central bankers, that this is transitory. And that's not just one central bank, that's your major central banks around the world, from the US Federal Reserve to the UK Bank of England to the ECB, European Central Bank, BOJ, RBNZ, RBA. All of the main central banks have this emphasis, have this theme at the front of their minds, okay? And what we're going to do is do a bit more dive into this. Are you guys okay with this so far? Are there any questions so far? Are you guys okay? Give me a yes or a 1 if you guys are okay so far. You've got to sort of understand this so far. Okay, thank you, Carolina.
Yes. Can you repeat, please, what is QE?
Yeah. If you can ask those questions by chat, please. Let's not speak through this session, please. Okay. So please do ask those questions in the chat. Okay. QE was a method actually brought in by the Bank of Japan quite a few years ago. I think it's almost over a decade now. And what it does is to, when you've got a falling economy, the economy is not growing as the central bank would like it to, and you've got low levels of interest rates, that means you've got no firepower. You've got nothing that you can use to help prop up the market. So what they started to do is to buy the assets themselves. So what they'll do is they'll print more money. They'll print more money when there's more supply. They tend to see individuals wanting to spend more money, and eventually they'll also begin to buy assets to help prop up the market. Okay, so that is what QE is. Yeah. Okay, so we're going to touch on more things. Don't worry, there's a lot to sort of discuss. Okay, let me just clear my screen so far. So we've covered some of these key points over here so far. Okay, we may come back to this a little bit later, but there's a few things that I wanted to actually show you from a visual standpoint. Let me just bring this up over here. Just give me a moment. Okay, so this is our community. This is our community where we have a lot of our discussions and so on. But I just want to share some content that I've highlighted there. Let's try and zoom in. Not a clear picture, but you get the picture over here. Okay, so it's not a clear picture, but hopefully you can understand some of the words over here. Now, this is the week ahead. Okay, this is the week ahead. Okay, so on a weekly basis, we sort of outline what areas you need to sort of look into. Now, this week is a very important week when it comes to inflation. Now, inflation data is CPI, the CPI data you see over here. So we had yesterday CPI data. This morning, we had CPI data being released. At the same time, we've had overnight, the RBNZ, New Zealand Central Bank, discuss what their forecasts are. And they came out very hawkish. They're already discussing tapering. They're already discussing reducing their quantitative easing program. Okay. In addition to that, we've got the Bank of Canada this afternoon. This Thursday, so tomorrow, we have Australian jobs report, UK jobs report, and then on Friday we have the BOJ with their interest rate decision, or should we say more quantitative easing progression, and their guidance. And then we have US retail sales. So it's a very busy week for exactly what we're talking about at this current moment. Now, to highlight the focus being inflation and why inflation, I've really gone from a data standpoint that GDP and employment levels are not back to pre-COVID, but we're seeing that inflation is overshooting those pre-COVID levels. Okay. Now, what is inflation, right? So generally, there's one main gauge used to outline what the inflation levels are, and that is CPI. That is what we're seeing here is the CPI data that's being released. Now, that is known as Consumer Price Index. And what it does, it measures or examines the weighted average of prices of a basket of consumer goods and services, which includes transportation, food, medical care. Yeah. So it is calculated by taking price changes for each item in the predetermined basket of goods and averaging them on an ongoing basis. Okay. So the changes in the CPI are used to assess price changes associated with the cost of living. So this will have a natural impact to you. Now, you know, the CPI, this CPI data is the most frequently used statistic for identifying periods of inflation and potentially even deflation. Okay, there are cases where we've seen hyperinflation. You know, think about Venezuela, you know, a year ago, Argentina a couple of years ago. Maybe look into that as well. And that's hyperinflation, where inflation is completely out of control. Okay, so we already spoke about, you know, central banks making these adjustments and so on. But what do central banks want inflation levels at? Okay, where do they want inflation levels? Well, most central banks around the world would want inflation and they target 2%. They want inflation year over year to grow 2%. That's the goal. Sometimes it's under, sometimes it's slightly over, but you know, it's quite rare for it to overshoot significantly when you're looking at one of the major economies. Okay. Now, you know, just to mention, right, some of the most recent rhetoric from your Fed Chairman Jerome Powell to Bank of England's Haldane to the ECB head Christine Lagarde, who was originally the head of IMF. She just stated over the weekend, that it's okay if we overshoot that number, that 2% number, for a bit longer than we currently plan. It's okay to overshoot. So instead of, you know, suggesting that, oh no, we're overshooting, we need to make adjustments, we need to tweak, we need to do something, because they believe it's transitory, they are willing to let it overshoot for some time period without making any changes, which to the markets means that they're becoming accommodative. They're being accommodative. Okay. So, you know, even the Federal Reserve have indicated that inflation is going to be running a little bit hotter than normal, and that's okay for the time being. Again, another support of being accommodative. And please do note going forward, when you do a bit of reading into some of the financial themes, you know, you're going to hear the word accommodative. You know, central banks and accommodative on an ongoing basis. Now, for you, an individual person, higher inflation, you know, is not good news. Okay, because what it does, it increases the cost of living and the cost of doing business. Yeah, it also isn't beneficial for a government, as it increases their cost of borrowing substantially. Okay, on an ongoing basis. So, you know, we are seeing that inflation, you know, and it soaring has become a central theme in 2021 that has dominated, you know, conversations from what we're discussing here to economists, to analysts, to bankers, to even the daily news flow that we're hearing on an ongoing basis. Okay. So what I'd also like to show you is the ongoing scenario, So everything we try to do, we need to have support by evidence, by statistical means, and that's what I'd like to show you here. Okay, so what we're going to do is we're going to look at two countries. We're going to look at the US first, and then we're going to come over to the UK. Okay, so let me just zoom in over here. Okay, so what we have here is the ongoing GDP rate, the annual growth rate in the US, the annual growth rate in the US. And as you can clearly see, pre-COVID, you saw sort of 3.1, 3.2, 2.5, 2.3, 2.1, 2.3, and then a bit of a drop in the first sort of period going into the new year in 2020. And then you have that large drop when the entire planet almost, was in a complete lockdown, right? So, national restrictions, national lockdowns occurring across major economies. And we saw a negative 9%, And they often say, that if you have 3 months of negative GDP, that is seen as a recession. And we had a whole year of a recession. Okay, so even though we had that initial view, but we did see the recovery here. Okay, so there is some recovery. If I just use my pen now. So even though, overall GDP has, remained slightly down but stable, and then we had that sharp drop occurring, we are seeing that it's starting to recover, but that recovery is starting to slow down. Okay, so that's what we're seeing now. We're not back to COVID regions, okay, pre-COVID levels. That's the key part there when it comes to the GDP levels. Let me see if I can move to the next. Okay, here we go. Now this is the US unemployment rate. The US had a historical record of unemployment levels being at the lowest levels. I think it reached down to 3.2%. 3.2% unemployment levels in the US pre-COVID. Okay, 3.2. So I would say between 3.2 to 3.4%. With the lockdown, we saw this large shoot occurring. Okay, so we're reaching close to sort of the 15% mark, or just to surpass the 15%, or maybe slightly below. Okay, so we're in this region here, getting up to 15%. As soon as most of the restrictions were reduced, we've seen a good sort of a recovery occurring, but that recovery is not continuing lower, right? It's starting to smooth out. We're starting to smooth out, as you can see over there. Right? In fact, there's an uptick on the very short term. Okay, so even though there is recovery, it's starting to slow down, but there is an uptick potentially occurring, as you can see over here with the most recent data. So again, that is not a fantastic way of viewing, as there is this ongoing fear with the new Delta variant and cases starting to grow again. Will there be further national restrictions? Furloughs coming to an end, and what does that mean? I think there's a lot of discussion about staff shortages, because the individuals that were furloughed have found alternate jobs, and there's all types of sort of discussions at the moment with the labour force. Okay, but this is what's been viewed when we are looking at the unemployment levels in the US. Let me just clear this and close this down. And then, of course, what we have here is, let me zoom in. This is your inflation rate. Okay, this is your ongoing inflation rate, month-on-month figure inflation rate. So you can see, the majority of 2020, inflation remained quite far away from the 2% mandate. Okay, so it's being that level there, 2%. We were undershooting quite often, right? But as soon as we come out of the most sort of recent sort of national lockdowns, we're seeing those inflations jump. And they're not just jumping a little bit. We have just most recently reported, just yesterday, had reported that June's inflation level has beaten not only the previous, which was at 5%, but also the estimates, the economist estimates, for 3 months in a row by posting a 5.4% year-over-year increase. Okay, 5.4% year-over-year increase. Okay, That's well above the estimated 4.9%. So they expected it to come down a little bit to 4.9, but that didn't happen. Okay, so this is yet another blowout inflation reading. Makes it increasingly difficult for the Fed to stick to its position currently, that that these higher inflation levels, it's due to just merely transitory reasons. Okay, it just can't be those reasons going forward. So my prediction, my forecast when it comes to yesterday's data, when we're focusing on the Fed, is the fact that it is likely the case for a rate hike where the Fed had recently stated that there's going to be 2 potential rate hikes in 2023. That may increase, that may be brought back a little bit. Okay, we may see that taking place in 2022. So next year, towards the end of the year, we may see rate hikes. But what I do expect is next month, with Jackson Hole Symposium taking place in August, we will potentially see discussions of tapering the quantitative easing program. So tapering of quantitative easing taking place. Okay, so yes, this is the key factor there. Now let me just quickly sort of hide this. I was trying to keep your microphones muted if you don't mind, please. So that's the key point there. Let me just now come over to the UK. Okay, so UK. So looking at the UK figures, you could see sort of GDP. This is what GDP has been like in the UK pre-COVID, 2020, right? Pre-March 2020. You can see 1.1, 1.4, 1.2, 1.7, 1.5, 1.4, 1.2. So just a very slow sort of month-on-month figure growing. Some months are a little bit hotter, some months a little bit slightly weaker, but nothing negative. Then we all of a sudden have negative, and we still are negative. Okay, we still are negative. Okay, so even though we had a sharp fall from the 1.2 down to a negative 21%, or just over 21%, there has been some recovery with that initial recovery, but then that recovery is starting to slow down, right? So that recovery is starting to slow down. Okay. When it comes to the GDP in the UK. Let me just close this and also just bring up the employment figures. Okay, so this is your unemployment rate. Okay, unemployment rate in the UK. So we've seen the fall from sort of the 2017 regions. Okay, so 2017 regions coming back to lows, the lows being close up to 3.8%. Okay, so 3.8%. That's the floor that we can see over here. And then COVID comes along, and then all of a sudden we see that jump up. Not a significant jump, but we're looking at a jump back to sort of, it predates 2017. Okay, it's predating 2017. We're looking at 2016 to 2015 figures potentially. Close enough to surpassing the 5%. And now the recovery, how much of a recovery? Not much, right? Not much of a sort of recovery. We're still well above 4.5%. Okay, so we're in this region between around 4.7%, as you can see over here. So not a huge recovery as of yet when it comes to employment. Employment. I'm just adding people to the room, guys. I can see people still waiting in the waiting room. Okay, yeah. So that's what we're seeing with the employment figures and unemployment rate in the UK. Looking through to the UK inflation numbers, so the UK inflation numbers. So it just came out this morning. Okay, it just came out this morning, and I can pretty much show you if this persists. Let's minimize this for a second. Let's move this to the side. So a good tip is try using tradingeconomics.com. This is a good website to source the economic calendar plus all other economic indicators and so on. Right? We're looking at sort of this morning's data. And yeah, you should be able to sort of find the morning, most data in this region over here. Okay, and this morning at 7 a.m. we had inflation rate year over year for the month of June. That may need to be refreshed because just give it a moment. Here we are. Okay, so we've got the actual numbers in place now. So at 2.5%. So the previous was 2.1%. The consensus, the forecast was 2.2%, but it's 2.5%. So we surpassed the 2% sort of region. And inflation rate month over month at 0.5%. So bring this back to, just give me a moment, let's bring up our community again. So this is your inflation rate currently, with the most recent data from this morning at 2.5%. And this is growing, right? So as I said, most central banks want to keep their inflation levels at 2%, this region here. We've stayed under for some time, during the period of COVID. But since then, we've very quickly have surpassed the 2% measure. We've surpassed the 2% measure, and it's continuing to grow, even though employment levels are not coming back in line and GDP levels are still in the negative. Okay, so let's minimize those. Right. So, what does that mean? What does that mean for we spoke about, what it means to you as a trader, and we've spoken about the data in place. I think if I just bring this up over here, this will be key over here, because what this is showing us is, just bring that up again, that the typical inflation target levels for most central banks at 2% in this region over here. Okay, and we've seen already the US has overshot this substantially. They're at, in that 5% region. The UK has just surpassed that also. We've seen other central banks also pointing up, even though GDP levels and employment levels are not back in line to sort of pre-COVID levels. So what can we take away from this? What can we take away from this? So now it's down to you. I like to give you ideas. I like to give you sort of, suggestions of, what you could potentially do. So this is the sort of the fundamental view. Okay. So some economists believe that this indicates long-term inflation that is here to stay, and it's been triggered by government stimulus exceeding the output gap, and the output gap meaning GDP, okay, in the economy, which has caused the economy to overheat substantially. So that's, significant amount of money printing is now having a knock-on impact on inflation levels because of all the sort of COVID packages were provided by most central banks and governments. Okay, and that's what economists are suggesting, that inflation is here to stay because of the stimulus packages that was offered in 2020 with COVID. Yeah. Now, central bankers are on the other side to this. They are suggesting it's transitory, yeah, and it's likely that it will decline quite quickly as supply chains get back up to speed. And we're also seeing this pent-up demand, which means that individuals that have not gone out shopping or not gone out on summer holiday are all raring to go. They're all raring to spend, coming out of these lockdown restrictions is only going to lead to an outburst of demand in a very short period of time, which will eventually cool off, is what they're suggesting, right? So it's down to you. Do you believe that it's, from the economist's view, that the inflation is here to stay, or are you with the central bankers that it's transitory and eventually, it should cool off? I'll leave that to you guys to decide. But how can you trade in an inflation period? Okay, and that's what we're going to discuss next. So that comes down to the 4 quadrants framework. This is often discussed by one of the top hedge funders in the world, Ray Dalio. He often sort of talks about depending on prices, economic activity, you can quickly adjust your portfolio based on the inflation zones that we can see at the 4 quadrants that we can see here. And the one, so we're going to talk about the ones that we're not in: inflationary bust. So of course, cash in safety is the safest currency. Okay, so stay in cash. Sell all your financial assets if you're in an inflationary bust. Disinflationary bust. The best bet is your government bonds. Okay, and then sell everything else. Be in government bonds. And then disinflationary boom. Innovative companies with pricing power. Sell companies with little pricing power. At the current moment, we're in an inflationary boom. That's what we're seeing now, is an inflationary boom. Okay, so what types of assets should you be looking to buy? Well, stores of value. Stores of value is key there. And that falls into some of your physical assets such as real estate, gold. You can get ETFs in gold as well if you choose to. Commodities do rather well. High fixed costs, cyclical producers. That's the key there. Sell long-term bonds. Okay, sell long-term bonds will probably be a key focus here. Now, this is all dependent if this inflationary boom continues. And I've shown you the data, and I've shown you where to look for that data, so you can do it yourself. Okay, so go into tradingeconomics.com and look at the ongoing data being released, and you can understand whether are we still in the inflationary period or not. Okay? And this should help you decide what types of assets to look into. Now, so far, year to date, this is what we're seeing at this current moment. Okay, so the oil market has gained the most. It is up by 45%. Commodities are just over 30% gain year to date. Bitcoin, cryptocurrency, we focus a lot on cryptocurrency, is up by 12.1%, even though we've seen the fall from the 63, 64K mark back down to around the 30, where are we now? We're at 32,300. Okay, but we're still up year to date. Stocks have done reasonably well. Actually, they're doing fantastically, really, if you think about it, because they go on to keep making new all-time highs. And year to date, they're up 12.5%. High yield corporate bonds, 2.6%. Dollar has regained on the hopes that there will be hikes in interest rates or tapering done with QE programming. Okay, so if that takes place, the dollar will strengthen. The dollar will continue to strengthen. Okay, whereas the dollar has fallen substantially in the year 2020. Holding on to cash is definitely not worthwhile. Think of this, right? Any cash that you hold on to is losing value by 5% a year from now. Okay, that's what that data shows, that it loses value 5% from now. Or the other way to see it is the cost of goods and services that you buy on a monthly basis is going up by 5%, whereas your salary or your income has stayed the same. Okay. And then you have your government bonds and gold. Gold is a safety asset. There is no large concern. There was that initial all-time high that had taken place with the COVID pandemic, but now gold is becoming lackluster, right? It is also seen as an inflation hedge, but then it's really butting heads with the crypto assets as well, also maintaining that inflationary component, as Bitcoin has a limited supply of Bitcoins available up to a certain time period. Okay, so those will be your assets to review on an ongoing basis.